Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 355 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including implications of a new Fed chair on the market, an update on the Social Security Trust Fund, how different interest rates affect bond prices, and a debate on using 529s or not for college savings. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So, Matt, pretty busy week in terms of news. We have a new Fed chair. We have the latest inflation report that came out. U.S. and Iran have supposedly agreed to a deal. So there's a lot going on at once here this week.
Lots to unpack for the market. You know, what's interesting is you and I were talking offline over the past week, thinking about the U.S.-Iran deal. You made an excellent point, is how much of that was already priced in going into this time period, knowing that the midterms are in the fall.
Right. Yeah, which, you know, will lead me right into kind of my next point when we get to big headlines and current events. But obviously, we had a big spike in the markets on Monday after the announcement of this. Has since pulled back due to a myriad of reasons. One being the new Fed chair with his first press conference yesterday. But we'll get to that here in a second.
All right.
But as always, we will review the month to date and year-to-date performance of the major market indices that investors track. This data is from Y-Charts and as of the market close on June 17th. S&P 500 index down 2.1% for the month of June and up 8.4% for the year. The Dow Jones Industrial Average up 0.9% for the month and up 7.1% for the year. NASDAQ Composite Index down 3.5% for the month and up 12% for the year. The Russell 2000 Small Cap Index is down 0.2% for the month and up 17.8% for the year. And the Vanguard All World X United States Index Fund up 0.4% for the month and up 14.6% for the year. 3-month Treasury rate at 3.83%, the 2-year at 4.2%, and the 10-year at 4.49%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
So as we were talking earlier, Matt, U.S. and Iran strike a deal to end the war, opening up the Strait of Hormuz. Oil prices dropped and stocks were up, like I said initially on the news on Monday morning, but has since given those gains back as of yesterday's market close.
Yep. Yeah, I mean, I think at the end of the day, I think you're spot on. The market has been anticipating that the runway the administration had in this conflict was limited due to a midterm election year. And I think we've talked about that many, many times in the podcast, and that has now come to fruition. And so if I had to argue, now the focus of the market will start to shift, assuming that this deal holds together, and we go back to the meat and potatoes of what moves the stock market: corporate profitability, growth rates, inflation with where oil prices are. All the basics are going to come back into play now.
Right, and we're not too far away from earnings season for Q2 reports to start to come out here in the next couple of weeks. So
don't you just enjoy earnings season?
I do sometimes. Depends how it's going.
Well
Depends
said.
how it's going.
Well said.
So,
well said.
The new Fed chair, Kevin Warsh, held his first press conference yesterday on rates, which were left unchanged and potentially left the door open to further hikes if needed later this year. I think CME futures are pricing in at least one rate hike before the end of the year, which is quite interesting, I think. And I think that's due to a lot of the inflation numbers we're continuing to see. So last week's inflation report came out. CPI was up 4.2% year over year, which is the highest level in almost 3 years. And PPI, the Producers Price Index, was up 6.5% year over year. So not crazy high numbers, but they're not small numbers either. Not numbers that warrant additional rate cuts, in my opinion.
No, I would agree. And I did a piece this past week with questions with Matt and Mark, and I showed oil futures going out. This is on Monday, Mark, the rest of the year. And you're now seeing late summer, early fall, at least future prices indicating where oil was pre-Iranian conflict. And I think the big what if is how long it takes for the supply chains to normalize and how quick those prices are going to come down and be reflected in this inflation data. But let's just say it for what it is. The economy is doing a little bit better than mainstream news media, I think, is portraying it. And the interest rates at where they're at are justified right now.
Right.
That's the fact, in my opinion.
Yeah, I would agree. Moving on to tweets, articles, and research from this week. The first thing I had was a chart from the Retirement Weekly newsletter from Taylor Schulte on June 12th. So Jenna will put this up on the YouTube page. So essentially what this is showing is the volatility in returns following new Fed chairs. And Taylor said that history shows that market turbulence during a new Federal Reserve chair's first year is normal. In fact, since 1970, the 7 completed transitions averaged an 8% forward return, but every single one experienced drawdowns averaging negative 17.5% along the way. Returns ranged dramatically from Greenspan's minus 21.2% to Yellen's plus 17.7%. With Chair Warsh recently starting, the S&P is down 1.2% with a 3% drawdown so far. The takeaway, leadership transitions historically bring volatility, but staying invested through these periods has generally rewarded patient investors who maintain their long-term strategy. So
then you overlay it, and we're in a midterm election year.
Yeah, and we're in a midterm election year, so makes it even a little bit more difficult. So again, when these things happen, it tends to bring on some volatility. So I don't think we should be necessarily surprised by that.
And that's why I'm glad you brought it up, because this is normal.
Right.
This is normal in the stock market. It's not just going to go up a little bit every day, nice and easy. And I think that it's a nice reminder.
Yeah. And, I think it's another, quote unquote reason for the market to take a little bit of a breather. Coming into 2 weeks ago, the market was up 9 weeks in a row from the lows in late March.
Yeah.
And that's just not sustainable. And, these are it's interesting how, some of these things and these stats come out right around the time that, the market is due for a little bit of a breather. I think it's just funny how the way the world works.
Yeah. And I think you would, from your chief investment officer, windshield, I think that you would say, hey, these types of pauses are actually healthy in the grand scheme of this uptrend that the market is in. And when these pauses happen, if you're underallocated to equities, you're going to get your turns at bat, but don't come crying to me later this year if you're underweight.
Right. Yeah. Good point. Second thing I had was an article from Lori Konish on June 9th. So this was an article on CNBC titled Social Security Retirement Trust Fund May Be Depleted in 2032. New trustees report fines. And there's also commentary from Kitsis.com here. So it seems like every year, Matt, this comes up a couple times a year about the Social Security Trust Fund and if it's going to run out of money and if Social Security or people who are receiving Social Security are going to continue to receive their full benefits, right? Mm-hmm. So they say, according to the latest edition of the trustees report released this week, the Old Age and Survivors Insurance Trust Fund, acronym OASI, is estimated to be exhausted in the fourth quarter of 2032, 3 months earlier than was expected as of last June.
Okay.
If the OASI trust fund were to be depleted, the system would be expected to pay out approximately 78% of scheduled benefits funded by ongoing payroll tax receipts, which would be a major haircut, particularly for current beneficiaries who rely on Social Security benefits to fund their lifestyle needs. That said, there remains time for Congress to act to shore up the Social Security system in advance of the expected depletion date. To start, the OASI trust fund could be combined with the trust fund for the disability insurance program, which is in much better health. But according to the latest trustees report, such a move would push out the exhaustion date of the combined fund to the third quarter of 2034, at which 83% of benefits would be expected to be paid out. And for the longer term health of the Social Security program, additional changes would be required, which could include tax increases, benefit reductions, or a combination of the two. So I feel like we talk about this once or twice a year. Like I said, there's a lot that can be done to shore up this system. And I think if any politician was smart, they would make this one of their primary talking points when they're campaigning for the midterms and all of that. Because that will pull very well to shore up Social Security. It's not going to be very popular if someone says, we're just going to let the benefits get reduced by 20-30%.
You articulated that perfectly, in my opinion. I would just add one more thing. I would argue, I'm going to be a forecaster in the 2028 presidential election. This will be a top 3 topic on the campaign trail.
Yeah, I would agree with you. It seemed like, we were talking about this in 2016 and 2020, and it still seemed so far away, right? But now it's like we're getting closer. We're getting closer, and still nothing has changed.
That's right.
Last thing I had was a post on X from Ryan Dietrich on June 15th. He says the S&P 500 is up about 10% year to date, but it rarely ever finishes the year around average. Could stocks really finish flat from here? We'd say no, and this is another reason to expect a strong second half.
Great point. Everyone thinks the market averages, those high single digits, low double digits, depending upon the time period you look at, but it rarely comes in at that.
Yeah, looking back at this chart from Carson, going all the way back to 1950, there was 1, 2, 3, 4, 5 instances that finished like around average, that being 8.5%, 9%, 9%, 9.5%, and 10.5%.
Yeah.
But it's usually way above the average or way below the average, right? So again, the market is not designed to give investors 7 to 10% per year. That's just not how it works.
You're talking about the averages, right?
Talking about the averages.
So here's a word of wisdom that if you are in your retirement years and you have some better years in the market, a word of wisdom is to take advantage of that strength. Look around your household where there's deferred maintenance cost in your life. I'm talking about the roof. I'm talking about the cars. I'm talking about the bigger ticket items. And you might have an opportunity to take some additional withdrawals and spread that tax liability over a couple of years. Just want to throw it out there. These are the years where you need to be looking at that type of stuff.
Yeah, very, very good advice.
All right, Mark. My first piece is going to be an update on AI hyperscaler spending. Fancy term for these companies who are building these data centers, okay? Now, why am I bringing this up? This became a concern for the market about 3 times last year. And if I was a forecaster, it's going to happen a couple more times this year. We're going to have some people come out of the woodwork saying, wait a minute, I think we're at peak spending in this data center and because of fill in the blank. And the market will most likely hammer those stocks on a short-term basis. And then you tend to get an earnings announcement where it disproves that view. So we're going to go through this cycle. At some point, we will hit that, right? But this piece was posted by Mike Zaccardi. The timestamp on this, Mark, June 16th. Underlying source was FactSet and Goldman Sachs. So here's my prepared notes. Update on AI data center spending. Just like last year, we'll go through some periods this year where the data center spending topic will be front and center for the market. You're going to see clickbait articles and talking heads on financial news stations calling for the spending to dry up. Will growth rates eventually turn? Yes, as I said a couple seconds ago, but I don't think it's a 2026 topic. And by the looks of the consensus for 2027, not necessarily a 2027 topic there either. I'll pause there. The consensus right now is they're going to spend over $750 billion this year. And when I say they, the source is Amazon, Meta, which is Facebook, Alphabet, which is Google, Microsoft, and Oracle. And the projection next year, Mark, is a rise of over 20% to over $900 billion in spending. I think this is a more relevant topic later in the decade and will most likely coincide with a tougher tech trade when that happens. Now, why is this important to the markets? A lot of larger companies by market cap are involved with profiting from this topic. Something to definitely keep your pulse on, in my opinion, and expect this to be a focus of the market a few more times until year end. This happened several times last year as well. Your comments before I continue.
Yeah, well, I think, this is in large part a reason why you've had, this meteoric rise in, the semiconductor industry over the past couple of months, for example. There's a lot of other things behind it, but this is one of the reasons. You have, some of the biggest companies in the world spending, almost $800 billion, right? That's
this year. In
a year alone. So obviously they think this isn't going anywhere anytime soon, and this is just going to continue to be a larger and larger portion of the global economy. And the one thing that I'll leave it off at is, these companies wouldn't be spending this type of money if they didn't have conviction on where this AI
these C-suites aren't going to authorize that
is going, right?
Yeah, these C-suites aren't going to authorize that. All right. Thank you for those comments. I think they were spot on.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
Next, I have some interesting data on the American consumer. Not sure if you've seen this data point yet.
Have not.
This is going to be a very interesting roundtable between you and me. So Ryan Dietrich posted this chart on June 14th, and the underlying data source is Ben Carlson. So let's have a roundtable on this data. This chart will definitely be in our show notes. And for our traditional podcast listeners, Mark, I'm going to verbalize the data on this chart. Jenna will put it up for our YouTube viewers who are watching this by video. And as a kind reminder, all of these charts and our show notes will be on all of our major social media sites, things like Facebook, LinkedIn, X, etc. So what Ben put together is a share of families in each socioeconomic class, and it has 3 specific years, 1979, 2001, and 2024. The underlying socioeconomic classes that Ben placed American households into, Mark, was the categories as follows: poor or near poor, lower middle class, core middle class, upper middle class, and rich. Here's the point I want to make. There's a lot of discussions about where the core middle class stands in America, okay? And when you look at where we were in 2001, the core middle class made up 33.2% of American households. When you go then to 2024, that figure had dropped to 30.8%. So when you see people, let's call it politicians, individuals in the news media saying we have a declining middle class, that is technically factual when you look at the data.
Both the core middle class and the lower middle class.
Yes, so the lower middle class, to give you the comparison, thank you, sir, 19.1% of Americans in 2001, that dropped to 15.8% in 2024. But what is the narrative that is getting lost? The upper middle class. In 2001, Mark, that figure was 21.9% of American households. And by the time we got to 2024, that figure was 31.1%. So you had a decline in the core middle class. I'm going to use some round numbers. 2.5%-ish. In the lower middle class, you had a drop upwards of about 4%, high threes. A dramatic, almost 10% rise. 50% rise overall in the figure over that 20-year period in the upper middle class. The rich from 2001 went from 2.2% up to 3.7%. So what's my point in bringing this up? I have had a constant theme for many decades now that the status of the American consumer is better than Wall Street tends to give it credit for. I want to be sensitive to the fact that there are the lower end of the American consumer, especially post-COVID, has definitely been pinched by inflation. But I'm a numbers guy, and I'm not trying to come across insensitive, but we are paid to manage money, and we're paid to make money. And at the end of the day, we got to follow the tea leaves on this. And at the end of the day, the upper middle class is doing quite well in America right now. And I feel that gets lost in translation. Your thoughts?
Yeah, I'd be interested to see what what data is used to determine if you're in lower middle class or core middle class,
like the
income threshold, to see what that is and how, and especially how that's changed,
how it's grown
over time, right? But no, I think this chart does a good job of showing that, I guess you could imply, I can't say it's fact, that you've had people move from the lower middle class and the core middle class to the upper middle class, right?
Yeah.
Which is a good thing, right? And the poor or near poor has also come down significantly since 1979 and since 2001.
Verbalize those numbers for our podcast listeners.
Yeah, so for the percent of American households in the poor or near poor group in 1979, that was almost 30% of American households. 2001, it was 23.6%, and as of 2024, it was 18.7%. So that's heading in the right direction, right?
It is.
And it means, I think, that, you're poor or near poor and now moving into, the lower middle class, core middle class, and even upper middle class, right?
Yes.
So yeah, very interesting data point here.
So I'm going to throw it out there. Again, I make comments from time to time on the podcast about my opinion on the status of the American consumer. I throw out data points. Another one, if you're a newer podcast listener, this is an important one. If you slice and dice the American consumer by household income in tenths, the top 10% of American consumers do 50% of the spending in dollar terms. That's dramatic.
Right.
So the status and health of that top 10% is unfortunately the tail that wags the dog.
Yeah.
We got to call it for what it is. All right. This next piece is a salute to you, Mr. McEvily. Okay. So for podcast listeners, over the past, I would call it month or so, Mr. McEvily has been discussing bonds and the fact that we have been in a lowering interest rate environment for many decades, and how we could be potentially on the cusp of a rising interest rate environment. And to continue, bond prices and yields have an inverse relationship. And what Mark was educating listeners and viewers on is if we exhibit higher interest rates, how will that affect bond prices? This piece is for you, buddy.
Great.
So this is from treasurybonds.com, an ex post on June 11th. This chart will be in our show notes, and this is going to be another one, Mark, I'm going to use your assistance in verbalizing for our traditional podcast listeners. This chart is titled How Changing Interest Rates Affect Bond Prices. So what we're going to do is we're going to play off of a 10-year U.S. Treasury. And at the time of this publication of the underlying data source, it was March 31st of 2026. At that time, the yield on the 10-year was around 4.26%. So what we're going to do is we're going to talk about what happened if interest rates went up by 2% or 200 basis points. What would happen, Mark, is if you held that 10-year bond and interest rates went up by 2%, your bond on average would lose 9.22% in the value you see in your account, okay? Mm-hmm. And we can give some other points here in a second, but you made a very key fact in a recent podcast. Most investors view the lens of bonds as a generalized category of, it's safe, I can't lose any money. And you and I know that is not the fact.
Right.
When you see this data, cherry pick one or two more for me that might get this point across to our listeners and viewers on how interest rates on the shorter term basis affect bond prices.
Yeah, I'll kind of go the other way. So if you're looking at the 10-year U.S. Treasury current yield at around 4.26%, if rates are lowered by 3%, if you hold that 10-year U.S. Treasury, you could expect to be up about 27.25%.
You're looking pretty smart and good,
right? So it really does have a huge impact on bond prices when we're talking about changing rates. And I think people who look at fixed income, most people are just looking at what is the interest rate I'm going to get paid on this. And that's
Bingo.
only one part of the equation. You have to balance that with the drop in price of that bond or fixed income security, whatever you're looking at. Right?
Yeah. And then if it's not a government piece of paper, then you're dealing with credit ratings and what's your likelihood of getting that money back upon maturity.
Right. So just because there's a corporate bond or a treasury bond that's stated to pay you 6.5%, might not necessarily always work out that way. Right?
Correct. I got one more point for our listeners and viewers, and this is an important one. The sensitivity to bond price movement has a magnifying effect the longer you go out with maturities. This is important. So if we go to a 30-year treasury bond, and on March 31st, Mark, that was yielding around 4.82%, if we were to see a rise in interest rates, I'm going to do the extreme one of 3%, that bond would lose almost a third of its value if you had to sell it.
Right.
So we got to realize that, the longer you go out in maturities, you might be tempted to buy a longer dated bond because it pays you more interest. However, what are you trading off? A lot more volatility, and it gets magnified. Your final comments before we move on.
Yeah, and then, again, playing just the opposite side of the coin there, if you look at a 2-year U.S. Treasury on March 31st yielding about 3.75%, an increase of 3% in rates just marginally positively actually affects the 2-year Treasury bond. So the shorter paper that you're buying usually is going to have a lower interest rate, but the price of the bond is going to be way less affected by changes in rates than, say, a 10, 20, or 30-year Treasury.
I'm glad you brought this topic up over the past month because obviously, and for the right reasons, our Independent Advisors podcast is going to be a lot heavier on stocks, right? I do feel that us highlighting the bond portion is definitely good for our listeners and viewers, and you've motivated me to bring up that topic, so I hope you enjoyed that one.
Yeah, it was very, very nice graph there. If people are not watching on YouTube, definitely suggest checking that out in the show notes.
Thank you, sir.
Okay, so last but not least, our financial planning topic of the week. So this is surrounding 529 college savings accounts and to use or not use them for planning for kids' college. So there's two separate articles that I wanted to reference here that advocate for and against using traditional 529 savings plans for college expenses, and would love to get your personal opinion on this after, Matt. But
here we go.
The first is an article by Delvin Brown in the Wall Street Journal titled "The Financial Planning Expert Who's Boycotting 529s for His Kids." And the financial planning expert that Delvin is mentioning is a guy by the name of David Blanchett. He's a well-known retirement planning specialist, and he recently has sworn off using 529 plans for college education savings. His argument is that by using a brokerage account, he maintains flexibility in what the money is used for. They're actively saving money that they may use for college, but not necessarily. The idea of an account built primarily around higher education is falling flat for some parents, and they don't want to tie up their money, especially for a degree that seems increasingly precarious. The payoff is less certain when college expenses are rising. He said he wants to help his children, but not in a way that assumes a 4-year degree is the only path. He said the most important thing to do is save money. How you save it isn't typically going to be as impactful. So that's one side of the story.
Yes, sir.
There's another article written by Anna Garcia titled "Why Advisors Don't Recommend 529s." She kind of outlines a different approach, and she kind of debunks some common theories that are out there. So the first common theory is that you'll get more financial aid if you don't have a 529 because 529s count against you. And she says you should use part of this advice is you should use a taxable investment account, Roth IRA, or insurance policy instead. So now Anna says if that person suggests that you use a taxable investment account instead, they simply don't know how financial aid works. Yes, a 529 is an asset, but so is a taxable investment account. The 529s are better for financial aid than taxable investment accounts because the 529 doesn't generate taxable income, either from dividends you receive on an ongoing basis or from capital gains when you sell the investment to pay for college. As for the Roth IRA, sure, it doesn't count as an asset, but when you take the money out, it's income on the FAFSA and CSS profile. That means it counts at 47% of its value. So $10,000 in a 529 will reduce your financial aid by $560, but taking $10,000 from a Roth IRA will reduce your financial aid by $4,700. And she says, as for the insurance policy, no, no, and no. Second common piece of advice that is out there is, 529s don't have enough investment options. And Anna says it's true that your 529 is more like your 401k than your IRA, where you have a set menu of investment options, including target date fund like investments, and most 529s use index funds, low cost, broadly diversified mutual funds that have historically delivered equal or better returns over extended periods of time than actively managed mutual funds and at a lower cost. The last one, what if your student gets scholarships and you don't need the 529? While it's true that most students get scholarships in some form, less than 1% get full ride scholarships covering tuition fees, room, board, and books. The other 99+% need some more money. So, with those two sides of the argument, where do you lie on this?
First of all, I think you did a great job summarizing both sides. I want to give you kudos there. I am an advocate to split this risk. So what I tell a lot of parents, especially grandparents, who tend to be funding a lot of this stuff, well, at least within our client base, I'll throw that out there, that funding half into a 529 to enjoy that tax-deferred growth and tax-free withdrawals if it's utilized for post-secondary education. And then on the other cusp, the other half go into a brokerage account that if the, say, grandchild doesn't end up going to college, the grandparent can control the distribution of that money when they feel the grandchild is going to be financially responsible. You know, and I tend to see grandparents utilize that for more life event, weddings, purchase of a first home, those types of events for the other half. I'm an advocate to split the risk because of these different factors that are at play. But, you know, I think at the end of the day, with the dramatic rise in the cost of college, you have a lot more skepticism that the default is, hey, my grandchild's going to go to college. That's not necessarily the slam dunk route that it was 20, 30 years ago.
Yeah, no, I would agree with you. I think splitting the difference is not harmful in any way. And, you know, you could even bake this into, you know, your estate planning too, right?
Ooh,
so
keep
if
going.
you have a trust account, you can write into the trust document that, you know, until my grandchildren or my kids turn age 17 or 18 or the year before they go to college, I want to put in X amount of money from my trust account to the 529 or a brokerage account that's used to save for college expenses, right?
Love that.
So I think there's not a one size fit all answer for this for everyone's personal financial situation. I do agree with David Blanchett you know, the first thing is just to make sure you are saving.
There's the first one.
So that you're not, you know, caught off guard when college, if and does come. But I don't think any of us know what higher education is going to look like 18 years from now.
No. And I got one more idea that could help parents and grandparents. If you're going to go the brokerage account route for all of it, half of it, what I see individuals do, Mark, is they will do a transfer on death beneficiary designation to that specific child or grandchild to remove it from their estate and designate it. Because I want to make sure, when I educate individuals on this, what we don't want to happen, most parents and grandparents, is they predecease this plan, and then all of a sudden what they've segregated for that child or grandchild gets folded back into their estate and divided in whatever their trust or will says. And so what I'll see a lot of people do is have that separate transfer on death designation, removes it from their estate, and it goes direct to that individual. Now, there could be a moral hazard there, which is, you know, the child's 20, not going to college, not making great decisions in life. Parent, grandparent passes, they're above the age of 18. That's when you have the instance. Heck, back when I was in high school, we had a kid that had a brand new Corvette from an inheritance. You know, you're gonna have that's a possibility.
It is.
And there's some enhanced estate planning you could do to put up some guardrails, but you see where I'm coming from. But it's an easy way to keep that separate and delineated to a specific beneficiary.
Yeah. Yeah. Well said. Well said. All right. Well, thank you everyone for listening to episode 355 of the Independent Advisors Podcast. Catch us next week for episode 356.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.